Grüezi miteinander. Hi everybody. Welcome to this hopefully interesting discussion with important people here. How is fund selecting doing the job? I think it's a very interesting question. And we have three people here represented on the screen as well. Anna Obenhuber, ladies first, of course, head of fund selection. It's more complicated than that. UBS Wealth Management. Then we have her colleague, which is Patrick Roefsn, who does the same job for Julius Baer. And we have Sébastien Gentizon, who is doing this job for Banque Pictet. Now, of course, we thought about a couple of interesting questions, and I would like to start with the question to all three of them to introduce themselves, what role they currently have, that's the question, but also the question, why do you think you are good at what you're doing? And I would like to start with Anna, please.
I love that question. So my name is Anna Obenhuber. I'm responsible for the fund selection at UBS Wealth Management. We are basically covering funds across the globe, ex-US. So we're also working very closely together with our colleagues in APAC, same process that we run across the globe. Why am I good at what I'm doing? I think inherently, and you may not notice that today, but I'm more of a listener than a talker. So I like to listen and basically assess people, and I'm also perhaps a little bit judgmental. I think that helps in this role. Really like to understand processes and kind of come up with an opinion and take a decision. I'm not afraid of that.
Glad to hear that. So how about you, Patrick?
Yeah, hello everybody. My name is Patrick Roefsn. I'm heading the fund offering team, a team of 15 people within Julius Baer, responsible for manager and fund selection, production of fund-related content, and also the communication of fund-related news through different channels. We cover about 50 billion of assets in recommended funds, and across traditional and alternative funds. And it's important to state maybe that we are not managing money ourselves. So we don't say, now you need to have US small caps because it's the right timing. So we just, based on the stakeholder demand that we get, we select the best possible manager and the best suitable product. That's our job, and our stakeholders are pretty happy with what we do, probably because we have a well-experienced team. The combined team experience in fund selection is over 100 years. And I think what we do really good is that we are well connected within the fund industry, with many of you as well. Also within the bank, with our stakeholders who ask us for the services. And also within the team. I think we do a great organizational learning within the team and the exchange that we have between each other.
Okay, thank you. What's your introductory statement, Sébastien?
Yes, hi everyone. So great to see so many familiar faces. My name is Sébastien Gentizon. I'm heading the fund manager selection at Pictet Wealth Management. I'm based in Geneva, so I enjoyed a great train ride this morning to come here. That being said, we are a team of 10 people, and we are in charge of the open architecture for the wealth management within Pictet. And we look at all the asset classes, and we select the managers for our offices in Europe, but also outside of Europe. Regarding if I'm really good at it, I'm not really sure, but what I can say that I think thinking out of the box is something really important. You have to be creative, entrepreneur in our work. If you do that, and at the same time, you also consider the main risk that you can have looking at scenario analysis. For example, what are the main risks to consider and comfortable with that? I think over the long term, you can take like quite interesting investment decisions that will be successful on the long-term horizon.
Okay, maybe staying with you, the obvious question from someone who does this for more than 3 decades, believe it or not, that's what I'm doing, asset management, producing. We have the famous 4 Ps, philosophy, process, people, and performance. Now, I would like to ask you what part of the Ps are relevant and what is missing in the 4 Ps. Maybe you continue, Sébastien.
Sure, happy to do so. I think we're still in a people business. We saw over the last quarter a lot of questions and buzz about AI and ChatGPT, so on and so forth. But I think the people behind, even when we look at quantitative strategies, to understand who are the people behind, why they build it, how do they build it, is really key. So we spend a lot of time on that, and making sure that in terms of alignment of interest, we are comfortable. We spend a lot of time on that. So we like the people behind and make sure that we're aligned with those people to invest within the next 3 to 5 years. That's what is the most important. When it comes to the 3 others, I will talk after about philosophy and process. Obviously, that's the DNA, and that's what we spend a lot of time on as well. And I think performance comes as a result of all that. If you do your job well, after the performance comes naturally, and the alpha generation should be there.
Mm-hmm. Would you like to continue, Rolf, please?
Well, from our side, I mean, we have the 4 Ps do play a crucial Patrick, yes, a crucial role, and. I mean, when it comes to performance or philosophy, I mean, it's not about just finding the best performing fund. That's easy. You use the Morningstar rating. So it's about philosophy in the sense of what's the DNA and in what market environment do you choose one or the other fund. So it's about style consistency in that sense. That's important when you select funds. On processes and people, of course, they have to be sound, they have to be consistent. But you also want to have a better picture on the manager as such. You want to see the manager, you want to talk to the manager to make sure that he's aware of the processes, they are disciplined, that he knows the portfolio. So if you approach him with a liquidity analysis or performance attribution, you want to get an answer and not him looking at the sales guy or so. And that's important, that the personality of the manager also lives up with the philosophy. Besides that, you have the other products, the other product features like size of the fund, do they have the right service level and so on, which also play a critical role in that sense.
I can't resist to ask a question which is not, which we didn't discuss. Morningstar, 5 stars. Do you have an opinion on that? Is that a good buying signal or not? I know the empirical stuff, but I'm not going to tell you right now. What's your take on 5 stars?
We have the discussion internally all the time about the Morningstar ratings. They are great as a marketing tool. I mean, it's great to see which fund outperformed over the last 3 or 5 years. That's great. But the fund was, the market environment was in favor of that fund. It doesn't mean that there is not the manager who outperforms all the time. That's not possible. It's to find out why did he outperform and then decide based on the market environment that you expect whether that's going to be the case going forward or whether you actually pick another manager which suits more to the upcoming market environment.
Okay, a good marketing tool, I learned. Thank you. May I pass the word to Anna?
Yes, so perhaps to add to that, I mean, we fully agree. Morningstar ratings is not something that we focus on in our process either. But I mean, ultimately, we want to understand who we invest in, and therefore really sort of look the portfolio manager in the eye, so to say, and get a feeling not just for the person managing the fund, but also sort of for the overall process behind it and the people around it. I mean, the most interesting conversations I find is when you're on site and maybe you speak to an not so experienced analyst, for instance, who hasn't sort of gotten used to sort of the nice marketing talk, but is more sort of upfront on what's going on in the organizations. I mean, what we try to do is really to challenge different people within an organization and also to compare notes between analysts who might be speaking to another manager, sort of asking the same questions over and over again, and with that build what we call a mosaic of understanding the fund. We actually speak of 5 Ps in our process. The 5th is price, where we try to be sort of differentiated as UBS and use our purchasing power in negotiating good and sometimes exclusive pricing for us, especially when we're early investors in a product. There we want to basically have a bit of an edge relative to others.
Okay, thank you. May you add with the next question? I read somewhere we have tens of thousands of funds to be bought in Europe. Now, this is a nightmare in terms of data. How do you dig through that? Or is it the other way around? It's just people knocking on your door, they want to sell the product. How do you deal with that? Do you ever find anybody in this data sea of opportunity without this company or person knocking on your door?
I'd say it's a bit of both, right? I mean, yes, people do knock on our door. So, and ultimately, I mean, we all have the benefit of having big teams and specialized teams. So the way we're set up on our end is basically we have a dedicated analyst on US equities, on European equities, and so on, right? So with that, every analyst is basically tasked with understanding the universe and the opportunity set that is out there. And that every analyst is also measured against the other funds that they could select, so they better know the other products that are out there that sort of are part of that universe, because otherwise they might be losing out on their own performance, so to say. And we do screenings. From our point of view, about 20% of our process is quantitative. The rest is fundamental. So screening is there. So either confirm sort of what you've seen with the manager and confirming that on an ongoing basis in sort of the monitoring piece, or to identify opportunities. And what we've done, for instance, historically, we've gone and set up managed accounts which aren't sort of available in a fund structure. Take US credit, where we have what we call a multi-manager access fund, which has 5 underlying portfolio managers in a managed account format. There, we didn't actually screen the Morningstar European universe, but went and looked for what's available both from Mercer and Morningstar and so on in the US, right? Because we wanted to have portfolio managers that you may not necessarily be able to buy in a fund format today. Okay. Now, that's a couple of years ago, so some of those have since transferred to Europe. But that's sort of the advantage of being able to build up such products dedicated to us.
Thank you. How are you doing that?
Yes, I think you have to start somewhere. You're right, it's a huge universe, so where do you start? So we also start with the quant screening. It's about the same, about 20% of our work. But when we build our database at the beginning, we also, with the chance, as I was saying, like to have a huge level of information and a huge network as well of other people outside of the usual databases. So we consolidate all that, and quite often actually we find some interesting ideas outside of the standard database that we have already. To come back on the entrepreneur spirit I was talking before. And the way we do it there is that we after gonna use algorithm, quite straightforward, but still on the 3 to 5 years investment horizon, and look the fund that did well, but we also go all the way to 10 years. And sometimes we would like to look at its fund that have been doing well over the last 10 years, but had a more difficult time over the last 3 to 5 years. That's the way we approach it. And after also we look at, in terms of constraints, you have a lot of constraints on the distribution side, on the risk side, on the liquidity side. But here again, we try not to constrain too much at the beginning because we want to make sure that we don't miss the best opportunities. And the way we do it is that doing some qualitative work quite early on. And we have the chance to have quite a big team, and we can offer to do that, unlike some others sometimes. Yeah.
Okay. Now,
maybe if I may add on that question.
Please,
I mean, yes, you do look at the databases, of course, but we all are larger institutions, and we have the luxury that many asset managers actually come to our offices or actually want to present their funds to us. So we, as a team, if you have 10 analysts over all these years, if you meet a lot of managers, I mean, 30 plus managers a week, and that builds up the know-how. So I could probably ask my analyst, who amongst others covers Indian equities, what funds do you think make sense? And he would give me an answer without even consulting the tool, right? But that's in a backup, of course.
Now we do have this grouping, this thinking along a return decomposition, which is bottom-up security selection, top-down economic environments, implication to industries, and you have this thing called style investing. What's your take on, no style works all the time? I'm missing that a little bit in this discussion now about how you identify interesting portfolio managers, especially in 10 years. I mean, you're going to have style cycles in there.
Yeah.
Do you look at that?
We do look at it, and again, in terms of data, the evolution of data is going really quickly, and the transparency of the holdings that we can receive from our counterparty is much better now than it was like 20 years ago, because I've been 20 years in this industry. So you can do a lot more things there, I think. And what we do when we do our screening, we actually not only use Morningstar category or those type of things, but also our own categorization based on the holdings of the portfolio managers. Because you can have holdings on the 5 years, over the last 5 years, for example, and you can define different style biases. And when we compare one of the manager we like, we're going to compare with the manager that has the same style, not necessarily that it's in the category large cap value in Morningstar, but the one that we, based on the holdings over the last 3 to 5 years, consider as a large cap value. Okay. And that's where it helps a lot to avoid surprises in terms of style bias over time.
Also on our end, style consistency is kind of a key thing that one is looking for. And we actually have we're using a tool called Quant Answers for equity funds that kind of allows us to map how equity funds are looking in terms of their style over time. So it's a holdings-based analysis that we're using. It used to be called PAS. It's an IB, UBS IB tool. And ultimately, I think the important piece to understand, I mean, you mentioned it earlier, right? The way we're embedded in sort of what we call the value chain is that it's our task to basically populate sort of house view ideas with the right product, right? And that actually means that we do need to have products that may not be performing perfectly well right now, but if the house view is changing, we need to be ready and have that product sort of in the lineup. So it's not that we're looking for sort of the best performing product last year when we're looking for a new fund. It's really sort of what is that product doing relative to what we expect it to do, and that's why it's so important to understand their philosophy, how sort of they've been positioned over time, the performance, sort of how it all comes together, so that we can have a bit of a forward expectation, and style is part of that.
Okay, Patrick?
Yeah, could just confirm what Anna said. Right now, there is probably more of a quality view in our house, so that means that we come up with solutions out of our broader shelf which fit that view. If we talk about factor-specific offering as such, we do have equity research guys who come up with calls on different factors. And we on our side, we also, on the passive side, we have also an offering dedicated to factor investing. But this is about 5% of the overall ETF offering and primarily driven by discretionary mandates. So for the advisory business, it doesn't play a crucial role.
Okay. Maybe go on to another question. Make or buy is a classic management question with corporations, but also in our industry. What's your take? I mean, presumably, I assume the split is 98% in-house funds, 2% third-party funds. I'm a bit provocative right now. How do you deal with that? I mean, one could argue we look for the best managers of the world. That used to be the value proposition of Frank Russell. We don't produce ourselves. And in the reality, my perception is rather it's completely the other way around. How do you deal with that?
So basically, your question is how we deal with UBS asset management funds in our case, so not passive products per se. So from our point of view, from a guidelines point of view, we're saying that we give UBS Asset Management a preferential treatment when equivalent or better. So that's the hurdle they need to overcome. Basically, that means that in the passive space, the equivalent is typically met as long as the pricing is right? So we challenge them on the pricing. I mean, we are independent and sort of fully away from each other from sort of a commercial perspective, in the sense that I don't have any incentive to sort of give them preferential treatment unless they perform for us. So in the ETF space, we have a lot of asset management products because they are sort of our beta solutions. And that is on the equity side, where we also have done a lot of sort of dedicated ETFs that fit with our house view. So with the sort of strategic and tactical asset allocation of UBS Wealth Management. So there we have worked closely with asset management to make that happen. And equally on fixed income, where we actually are not so keen on ETFs as a solution. We prefer sort of passive, semi-passive strategies, so a manager that kind of still keeps an eye on the portfolio and sort of what is in there and is able to really handle flows in a good way. There we also have a close collaboration with what we call cheap beta solutions, so to say. So if you look at sort of our asset management book, and just from an outside-in view, yes, it's about 50%, so not 98%, that we have with asset management, but it's really a large part of that is sort of those beta-like solutions. This said, they have some great, also more active solutions, and I know, hearing sort of from my asset management colleagues, that they often get asked whether we have them approved on the shelf, right? So that's kind of often a little bit of a quality check from an outside-in view. And what I just wanted to say on that is that not every solution from asset management might be fitting with our view, right? So we have a very sort of dedicated view with regards to how you should be invested from a house point of view. So the fact that we don't have an asset management solution on the shelf doesn't necessarily mean that it's bad quality. But we don't have every product that they have on offer also approved for wealth management.
Okay. I got one figure, 50%. I'm not sure how it's split between passive and active, but how is it then being done with PICTE?
Yeah, sure. Maybe just to come back on the open architecture. I've been with PICTE for 12 years, and something that I really appreciate, like being a private partnership, is that we have access to the partners on a relatively regular basis, but sometimes, I put it that way. And they always keep the same message. They come from this industry, they understand how difficult it is to generate alpha, especially nowadays, as we all know. So they really want us to select the best in class. And we have some of the partners who obviously are on the asset management side, and they have a business to develop and some objectives there. But they are really here for the long term, and we are like really freedom of selecting the manager that we want. So that's something that really great and that we appreciate. That being said, in terms of expertise in our asset management arm, for example, they have the thematic franchise that they have been developing for more than 20 years now. And they have some great funds, and we are really keen to work with them on that part of their business. But on the other hand, the way we work is that in terms of active versus passive, for your second question, the way we look at it is that we build our asset allocation similarly than what Anna was saying. We have our strategic asset allocation, our tactical asset allocation, and I would say that the majority of the investment for the strategic asset allocation are via active funds, and for the tactical asset allocation, because the investment horizon is much shorter, is via passive funds. And when it comes to passive, we are also here apply open architecture, and we have within PICTE some PICTE index funds, but it's still, relatively small, but there's some interesting offering there. But we work with the usual suspects, and we try to always find the best cost-efficient way to invest in passive. That's the way we do it.
Patrick?
Well, for the share of active and passive, we have a ratio of about 25% of the offering of our 50 billion, which is in ETFs, in passive investments. So there are cases when we say go for ETFs, other cases when we say go for active. Maybe on the discretionary side, it's more like 30 because they use it more for tactical plays and liquidity management. On the advisory side, it's maybe more 20. They also like more unconstrained strategies or conviction managers. So that's the one side. The other side of make or buy, it's pretty simple. We have a range of in-house funds which are managed along the view of our CIO, which are also building blocks and core asset classes for our asset allocation in the bank on the discretionary side. We have, as a second pillar, we have the proprietary solutions that we build up on our own platform, however, are managed externally. This can be sub-advised funds, but also feeder structures that we set up. And thirdly, we have the third-party funds where we play the open architecture approach. In Julius Baer, we come more from the side that we used to have a strong focus on open architecture. Also now I'm starting to realize that actually the in-house funds are not that bad, so this is something that we try to position a bit better. And at the middle part that I was mentioning, that's something which is running since 2 years. This is now just evolving. And all those funds, irrespective of what it is, they go through the same due diligence process. There's an analyst looking at this fund, make sure that the quality is there, that we only have top quality on the shelf, and then it's up to our stakeholders to decide on what they want to invest in.
Same for us. Same due diligence process, regardless of asset management or third parties.
Mm-hmm. I presume there are a couple of keen third-party fund providers in this room. And one of the some of the questions one might have, you answered by a rigorous process along a structure. There's this hurdle rate smaller companies tend to struggle with, and so do you have ideas about the minimum size of a fund to invest in, or of a company being able to make it to a long list with you?
I can start.
Sure.
Well, I think I shouldn't say that, but I don't think it's important to have hard rules, the 100 million, 3 years type of rules, because if you have a client who wants to invest in a frontier Vietnamese equities, for example, if you put these rules into application, you won't have any universe they're going to be able to look at. So we try to be as flexible as possible. And to come back to what I was saying before on the entrepreneur spirits, I really try to encourage the team to really look at those smaller managers. I think it's, the managers that are small today might be big tomorrow. I mean, it sounds stupid, but so that's really what we do, and we spend sometimes even more time to talk to those boutiques, to those smaller managers, because that's where you can find some interesting ideas. We have all access to those big databases where you have the big players that can provide all the information that we need. So that's sometimes with those type of managers that we tend to work. And after we are relatively big, but we have a great project management team and a risk management team as well that help us to onboard those managers when we really have a high conviction. So it's a lot of energy, a lot of work, no doubt about that, but the reward can be quite interesting over the long term. So
okay, that's the address for all the small guys.
Yeah.
But UBS, I imagine one needs to have billions in assets to make it to
Not
become
necessarily.
a client.
No, it's the same for us. You can't really put any hard rules in place. Then we wouldn't be able to do any kind of innovation. I'd say if you're coming to us as a plain vanilla equity fund, there are so many others out there. It's a little bit of a question of why should we take the risk of investing in a small firm that may not be there tomorrow, relatively speaking, right? So because there are so many others that would be an equally good solution for our clients. So what's important is that it kind of costs to do business with us for an asset manager. And what we need to make sure is that we have basically partners who can work with us across the globe. That requires registrations in all the major booking centers that we are operating with. That comes at a cost. It requires making sure that you're meeting all the regulatory requirements of all these booking centers. So it's more sort of that type of hurdle that I find that we face with very, very small asset managers that may not be quite ready for us. So it's not just kind of coming to us with a Swiss registered fund and focusing on the Swiss markets. We really try to, in everything we do, is to leverage what we do globally for our clients.
Okay.
So that's more the hurdle than assets under management.
That by implication raises then the initial assets,
Yes.
of course. Very nicely said.
I would agree to all what was said. Maybe even the global perspective is interesting also from a sales perspective. So often our stakeholders who ask for a solution also have an interest in some cases that it's more a brand name. Sometimes it's actually the demand for a niche name. That can also be the case. But often it's a brand name that they can sell, and also local presence of the asset management company. So that helps also, for example, in Asia, to position a product that you put on shelf there as well.
Okay, maybe continue with you. You and your team, you're also analyzing digital assets, cryptocurrencies. And I raised the sneaky question, would you personally invest a serious part of your pension money in those types of investments, or how do you deal with digital assets on that?
Yeah, so Julius Baer decided that we want to proactively deal with digital assets. So digital asset is probably one of the biggest macroeconomic trends that of our time, so to say. I mean, there are really interesting play fields of stable coins, Web3, metaverse, NFT gaming, you know that also. Really something where we said, well, we want to deal with that, we want to cope with that. We somehow see it as our duty to also give advice to our clients who would like to get support here. So that's why Julius Baer as a whole has implemented a research entity who provides advice on certain tokens. Wealth planning provides support to clients who have tokens in certain jurisdictions. We also foster an exchange with our clients through podcasts, webcasts, and so on. You know also that clients who would like to invest can do that via Julius Baer through our partnership with SEBA. They offer right now about 15 tokens where you can directly invest, and it's segregated money. And finally, that affects us. We also, for those clients who would like to invest indirectly, we also offer ETPs for certain tokens to invest in. As well, I would probably rather recommend a basket, ETP investing in a basket of several tokens. And we also added an active fund, which gives the opportunity to have direct exposure to tokens, then also exposure to hedge fund managers, playing relative value between the tokens, and even private equity exposure in one multi-strategy portfolio. I think that's also an interesting solution. But it's important to state that it's certainly not suitable for all clients. So the client needs to be fully informed about what he's buying and what the risks are. Ideally, he signs even a waiver. Secondly, the product is hopefully well selected. Thirdly, it's ideally diversified. And we recommend an allocation of 2%. So we have the colleagues from the Digital Asset Competence Center who calculated some math figures from the historic returns, and they say from a risk-return perspective, the efficient allocation is about 2%.
Very well said, well understood, it's possible to do that. I'm still struggling a bit with what is the typical client? Is it a woman? Is it a man? Is it a young person? Is it an older person? Or is it all over the place?
Right now, we don't see, there's hardly demand, I have to say. It's hard to say. I'd like to give you an answer based on experience that we have, but currently there is really no demand. We did the exercise. Beginning of last year, it looked totally different until March when the market turned. So the products that we've selected, actually, we had quite some pressure beginning of last year to come up with some solutions. Now there is much more time, actually.
Okay.
So.
Anna, I know UBS is not providing this service.
That's correct,
So
yes.
that question would be not well addressed. What's Pictet's take on it?
We are not on the long-only side. We are not offering any product at the moment. But we have a different entity called Pictet Alternative Advisors, who are in charge of the private equity and the hedge funds. And they did a lot of work already, more on the hedge fund side. And we work with them at Pictet, we're quite slow sometimes. So we're still in the process of understanding how things work. And to come back to what I was saying at the beginning, for me personally, the toughest part of that, even I spend a lot of time, I'm going podcasts, forum, listening to all what's happening to me, like many of you probably, it's the downside scenario. Every time you go to the downside, who was the main risk? It's hard to see where the upside can go, but the downside, you have no visibility. So that's why I think for Pictet today, it's still something that we are quite cautious on, and our senior partner is quite cautious on.
Okay, now a completely different topic, ESG. Maybe you would like to raise a question, please.
Yes, on the ESG side, the broad question is, how do you do good fund selection in ESG? Because, the passive side, I can read a methodology document, but I don't really know the people behind, the ratings that you get from the various providers. investments that are driving performance and risk.
So how do you deal with the topic ESG? How is it introduced? Is there a lot of attention with it? There is a little overhyped in my reading discussion about greenwashing, because once you look into the details, you simply see it's difficult. It's difficult stuff we have to answer. Or do you have critical discussions with asset managers about ESG to try to influence that? Or is it just the asset manager who comes to you and then simply explains how he's dealing with ESG?
So from our point of view, it's very much embedded in everything we do. So it's a strong strategic commitment from the bank to focus on sustainable investments. So that means that we actually analyze every fund that we have approved, and we have about 400 active and 300 passive funds approved. We analyze them based on sort of how is their intentionality to manage ESG. Now, we have basically, from our CIO point of view, a strategic asset allocation for sustainable investments, which is sort of talking about how you should invest in it from a portfolio context point of view, and that allows for different type of sort of SI strategies. So the classic approach to ESG, probably what you used to call best in class, sort of today you probably call ESG leaders or something like that. That is one piece of it, but we equally want to invest in funds that are focusing more on improving the ESG space, or funds that are really actively engaging with the companies they're investing in. So, but if you just take that sort of classical leaders approach and the improvers approach, I mean, that's sort of the most opposite poles in a way, because one is investing in everything that looks good from an MSCI ESG rating point of view, whereas the other is actually looking to invest in those that look bad today, right? So you can't really compare. There is no apples for apples comparison that you could necessarily do, which is sort of taking a bottom-up analysis of the portfolio and say, this one is good, this one is bad, right? So you need to understand how is every individual portfolio manager approaching the topic, what's their philosophy, and how they then go about sort of then also reporting that piece. So reporting has become really important with MiFID and SFDR going live, right? So all of that we need to analyze basically fund by fund. So today we estimate that about 20% of our analysis time goes into ESG, and actually that analysis was done about 2 years ago, so I think that's actually gone up even, it's my feeling, because there are many regulatory requirements we need to integrate into the process.
Yes, thank you. We have a question here.
As Roman mentioned, we may have some sales representatives, sales colleagues in this room, or relationship manager, whatever you call it. So question to you, please, what do you expect from a top-notch contact person? Do's and don't do's, maybe you have experience from asset managers, some new tools, services, etc. So please let us know, as of course your time is you're busy and we don't want to knock every second. So please help us to best service you. Thank you very much.
I can start. I think we have quite a bit of experience, so people know us, our contact knows us quite well, so they know how we work. We're all human with different expectations, different needs, so it's not easy for you guys sometimes to do with us, so thank you for that. But that being said, nowadays we receive so much information that we know it's obvious, but too much information kills the information, so to be quite selective on the information you send, sometimes it's better than send mailings on a weekly basis, because at some point you just don't have the time, you don't take the time to read it anymore. So personally, I spend more time looking when I receive one email once a month that is customized from one salesperson, then if I can say that, right, or some others when it's standardized and you see that it's just mass production, you just don't have the time to look at it. So that would be the key message for me.
Okay, can we go back to ESG question with Julius Baer?
Well, with Julius Baer, we have a ESG rating methodology, which we implement for all financial instruments. fixed income equities, but also funds. That's a mix of SFDR and MSCI ESG research. And we do then an overlay, a qualitative overlay, in order to find out in a qualitative way how they really implement ESG. Is it?
Sébastien, is there alpha in ESG?
Is there alpha? It's a good question. I think there is, truly, in the sense that first, at the firm level, we truly believe that. And academically speaking, you can have the answer yes or no, nobody knows. I mean, it's always the same thing. You can make your arguments. But I think, as Anna was saying, if it's part of the process and you look at it, it's quite interesting. She was saying that actually we spend more time on the ESG things today than 5 years ago. It's not necessarily because it's a regulatory constraint. It's also because people realize that there are a lot of interesting topics that if you are right on those topics, over time the company will avoid mistakes and the manager will avoid mistakes, which will benefit over the long term. So I think there is alpha, yes.
Okay, excellent. We are just 5 minutes. I would like to answer questions or give the opportunity to ask questions.
I want to stay with the G of the ESG and ask you, under the recent issues in the banking sector, do you now or expect to put more efforts on the G of the ESG, in the sense that they use their shareholder rights to really control the companies they own in their portfolios?
Does anybody have a view on controlling a big company from a governance perspective, please?
I mean, ultimately, I'd say most asset managers use their voting right with regards to sort of the as shareholders or as sort of engaging with the firms as a bondholder. And I'd say, especially when I grew up in fixed income, I'd say governance has always been quite a key focus from a fixed income point of view. I mean, even before everybody was talking about ESG. I mean, it's just a fundamental piece of the bond assessment that you need to do. Will something change? I think it's not necessarily because of I wouldn't link it necessarily to the recent developments in the financial industry or anything like that. I'd say the topic has become more important. There is more money coming into the segment, and therefore there is more of a voice to have that type of conversation. So I would probably see a stronger sort of engagement based on ESG factors because of the focus and the assets behind it.
Okay, we had a question back there somewhere, please.
You were talking about the quality and importance of an asset manager. You were talking about services. Can you tell us a little bit more about what is the percentage and how important it is, regardless of the selection or not of a fund, of the quality after the selections, i.e. what you are expecting from the asset managers from a reporting standpoint and from a qualitative standpoint? Thank you.
Well, after sales is important. I mean, that's also a huge part of our job. We have to deliver updates on a regular basis. We have to inform if something changes. We also produce content on a regular basis to keep clients, our stakeholders, updated. And that's a cooperation with the manager, of course. So if something is happening, we want to be informed, ideally first, so that we can communicate internally through one voice. We would like to have access to the manager generally, to also conduct manager videos, manager interviews that we also do as webcasts within the bank. So this availability is there. So there's a partnership in that sense. Once a fund is on the shelf, that we jointly do the efforts in order to position the fund as such. So updates, relevant information. Yeah, I think that's it probably.
Okay, we are almost out of time. One last question, please.
Yeah, I just have a question for Anna. What is your take on the new created bank? You're managing like 5 trillion. Apart from the 4 Ps we mentioned before, is there a new element you would say which is going to be determinant for the selection? So like the size, which has been always been very, very crucial. But is there also a view on, would you say that the recommendation list is going to shrink in terms of recommended fund or to increase? Thank you.
So I mean, we're still pre-closing. So from that point of view, not much to say at this point, right? I mean, the conversations that would kind of lead to an answer haven't taken place yet. So I think I shouldn't give my personal speculation on the topic. It's okay.
Okay, thank you very much for coming. Hopefully it was interesting. I thank the panelists here, and I wish you a good day. Thanks.
Thank you.
Thank you.